Welcome back, everyone, to one of our QX financial videos. We'd love to have you with us today. As you guys can see, I have our team, our leadership team here in our video today because we want to discuss what we believe to be a very important subject. A couple of weeks ago, there was a video circulated making a comparison between whole life and index universal life in the context of retirement planning and retirement income. So we decided to make a commentary on that video. So if you guys want to watch that video first, it's going to be right below in the description. So you guys can watch it as we go into our conversation. But the context of that video was IUL is better than whole life. And a lot of assessments and points were made in that video that we believe are not only inaccurate, but they are highly misleading. So we figure it's a great opportunity for us to set the record straight as much as we can, expand more on that topic, and let you, the client, decide which one could potentially be better for you. So let's start with that question, Terrell. You know, whole life and IUL, which one's better? Is that the right framework to ask that question?
Well, I think, once again, it comes back to this world we're living in where we have to have this definite answer and this is better than this, buy this, not that, go here, not there. And it's just sucking people in without filling them with enough knowledge and value so they can make their own decision. And at the end of the day, I think that's one of our problems we're seeing in the financial district so much right now is want a cookie cutter, you just need to buy this product. Versus trying to see what the person's needs are, what their risk is, what they see value in, because it's not really A or B option for these products. It's more on what the person's looking for and how it fits them.
Right. We have to be careful about not oversimplifying, or we have to be careful in simplifying too much and leaving out crucial parts that our client needs to address.
Exactly right. It's almost like asking what's better, a fork or a spoon, right? Well, what are we doing with this, right? What is the goal? And so I think it's very right. The question is misleading and doesn't really get to the core of the issue. And then the author of the video goes on into making an analogy that is like a cell phone, right? Because the cell phone, you can have an old cell phone and a new cell phone. So because a new cell phone is a smartphone, therefore it's better, right? So he makes that kind of analogy.
Yeah, because we know that the point of the phone is to make phone calls, and certain things may be important to others. Like say somebody who doesn't care about playing games on their phone and they just want to make a call, they're going to opt for an older phone, whether it be a flip phone or whatever. They just want to make the call. And it may be a different story if you're a younger person. You may want those bells and whistles, but the caveat is if you have those bells and whistles, you also have to pay a little bit more for those bells and whistles. So you can apply that analogy to a whole life versus an IUL comparison. And then while we're on that track, just think about the track record that a whole life product has. It's about 150 years versus the IUL, which only has a track record of 20 years. So.
Exactly right. So if we can look back and actually see true performance in every economic condition that's not available in the IUL, because IUL's only been around since the late 1990s, correct?
Mm-hmm. Yeah, that's right. And another thing to consider is that there have been some controversies associated with the IULs. There have been some lawsuits by some policyholders on these IUL products.
Exactly right. And I think for you guys that are watching this, as we go through this series of videos exploring IUL versus whole life, you understand what we mean by, why have people gotten upset with IUL and things that happen. We're not saying IUL is bad. All we're saying is you got to understand all the components to be able to make an educated decision. So then he goes on to talk about the returns. And he makes the claim that IUL is better because it's newer, using the cell phone analogy, but also IUL is better because you're going to make a higher rate of return, right? So Escobar, as he goes through that point about the rate of return, what is misleading about that point?
Well, the first thing I noticed was when he talked about how, well, with whole life, you're only going to get, 3 point something percent. But with the IUL, you might go as high as double digits, like 12, 13, or 14.
Mhm.
Well, it's true. You might go up to 14 and you might have zero. There's there's not like it's that guarantee, but what he completely missed the point on, and I don't know if it was intentional or not, that whole life companies, there are some whole life companies that have been paying their dividends for over 120 years. They paid dividends during World War One, the Great Depression, World War Two, the Korea War, the Vietnam War, and they paid them last year. They even paid them during the stock market crash of '08. So, it is, maybe they're not paying as high as some years of the IUL, but they never lost money.
And I,
Every client of every insurance company of our whole life, of the older branches, always got their dividends. And when they had to cash out the policies, they were always paid.
Go ahead, Terrell.
yeah, I just want to add to that, obviously the dividend's been around for a while, and that's what a lot of people I'm hearing will say in the IUL world is that, well, your dividend's not guaranteed. And as Scoba pointed out, most of these long-term mutual companies that have been around have been paying dividends for 100, 120 years. But I think more important, as people are constantly trying to be fooled, is this idea of this rate of return that we're talking about, and that it can be 12, 13%. But when you actually break down that internal rate of return, which most people don't understand, that's when we really get into these details about what you're actually making. So they suck you in with this 12, 13, 14%. But when we really look at those numbers, we see that never happens.
Right.
Exactly. So it's a bit of a marketing ploy. Go ahead, Sonia.
Exactly. So yeah, what people need to think about is the bottom line after you layer in all the costs. What are you actually getting? It's probably not that double-digit return that is hyped about.
Exactly right. And that's actually my following point with IUL, that he make it sound like you're gonna buy this thing and then you're gonna make double-digit returns and have all this money when you retire. And that's actually not the case. We have actually ways to measure what the potential return will actually be on an IUL. But before I show you this, I'd like to make another point that he also indicates that you kind of like your worst case scenario in a given year is to make that zero. But that's not actually accurate, because it's zero minus the fees and expenses associated with the product. So you're not actually making zero, you're actually making a negative return. Now, we're not saying that it's a bad thing or that the IUL is bad. All we're saying is that he's saying something that is not true. And that's where we have an issue. All right, so here I'm showing you a minimum rate of 0%, 11.54 cap, and I'm using that number because that's kind of the average across the industry. Products are going to have different caps and different things, but I just want to give you the idea. 100% participation rate and a 1 year point-to-point using the S&P 500. So we went back to January 1999 and showed you the numbers. The reason why I'm not going back to 1980 or 1950 is because those years are irrelevant. It's mathematically impossible to calculate what the cost would be to run IUL in 1970. We can look at the return of the S&P, but again, the S&P cycles, there's all these factors that are impossible to measure. So let's look at the IUL since IUL is being around. And then you can see here in the boxes, these 190th and 80th numbers. So what those are is just indicating what is the chance of me getting a rate of return. So as you can see, the average over a 20-year period has been 6.69, but 80% of the time, IULs made around 6.2. So these 14 or 12 or 20%, maybe 1 year, maybe even 2. But are you buying an IUL for 1 year or for 2 years? Or as he says, are you doing it for retirement income? So if you're doing it for retirement income, you're going to hold this for 50, 60 years. So that means that you're going to get somewhere between 5 and 6. And that's the reality of it. But there's another point, which is it's not just about the rate of return. It's also about how the policy is funded. And Terrell, he doesn't even make a point at all about that.
No, he doesn't. He doesn't talk about the funding because then we're getting into the details that most people don't want to talk about. And I'd say most, advisors won't even cover, which is the breakdown of your cost of whatever you're paying for and all the extra fees that go into it. And, I think we were talking about one, if we minimally funded something, the IUL doesn't perform. And we've seen that through history, as Sonia talked about, as people were lied to these big numbers and they minimally fund their IULs. And then they got statements saying they needed to pay more premiums because their policies were going to lapse because the fees outpaced what they were putting in.
Exactly. So if we minimally funded an IUL, and you can see in this graph that we're putting up for you guys, you actually return is negative 1.4, right? If you equally fund a whole life and an IUL, the internal in the IUL is 3.3, and the internal in the whole life, I'm sorry, is 3.3, and the internal in the IUL is 3.7. Technically the same, right? So all we're doing this is to show you that the funding of the policy, how you put money into the contract, also matters, and matters quite a bit. And that wasn't even discussed at all in his video. Go ahead, Scott.
I was going to say one of the things that they definitely don't want to share is that if two people at the same age, one bought a whole life, one bought an IUL, 20 years later, the one that bought the whole life, his funding is working more efficiently. It grows over time. The person with the IUL, there's a annual renewable term component that gets more expensive the older you get. So what we've talked about, you can potentially, as you get older, if you don't make any alterations, you might have to increase your funding to keep your policy in place.
You're exactly right. And actually that goes into the next topic, which is guaranteed versus non-guarantees. People don't realize that the IUL, especially when it comes to the cost of insurance, which is the point that Escobar is making, is not guaranteed. Isn't that the case, Sonia?
Yeah, I noticed that too, that he left out another crucial aspect of, a whole life and the IUL comparison. With whole life, you have guaranteed cash values, but with IUL, it's not there.
Exactly right. So that means that, as Scott was saying, if down the road the cost of insurance goes up, which, by the way, the company has the right to do so. The company has the right to increase your cost of insurance, reduce your caps, reduce your participation rate. All that is in the contract. And if they do that, and some companies have done that in the past, in the last 20 years. So if the company does that, then you're not going to get not even the 6 that we're talking about, let alone the 14 that he's saying that you can get, right? It's just not going to happen. I want to leave you guys with one last point. We don't want to throw everything at you in one video, but we're going to leave you with one more thing, which is what is the financial instrument that is actually underwriting the returns on the IUL? And that is the option. And the option markets might be the Achilles heel of the IUL. The options market is a fairly new market, as in the last 20 to 25 years. And it has gone through a lot of convulsions, to say the least, in the last 3 financial crises, including this one in 2020. So there is no guarantee necessarily that those options and that those trades that insurance companies are engaging in to fund the IUL will continue to exist down the road. There's no guarantee to it. The best example that I have of this is 2008. Which most of us understand as a mortgage crisis, but it was really a liquidity crisis. And most trades in the options market ceased for about a week, right? So people forget already how dramatic those days in September and October of 2008 were. So I am not saying that the options markets are going to disappear or anything dramatic like that. All I'm saying is that you depend on those markets continue to function efficiently for the IUL to continue to work. You don't have that problem with whole life. With whole life, what we are protecting is human life expectancy. It's all about mortality. And last time I checked, humans have the same mortality. We're still people, right? So as long as people remain people, we're going to have a similar performance, if not better, as we individuals age and pass away much older. So two different systems, two different mechanics. Again, I'm not saying one is better than the other. All I'm saying is they're different. And that needs to be understood before making a claim such as one product is better than the other.
Well, yeah, and to reiterate what Tyrell said earlier, if your risk tolerance is higher, I mean, absolutely, I will show you what the IUL can do. But if you're looking for secure, long-term, guaranteed payments well into your retirement, then we got to talk about the whole life.
Exactly right. That definitely will be as an area. All right, guys. Well, we're going to stop it right here. Next week, we're going to come out with another topic from that original video that we share in the description. He makes a lot of claims. He makes a lot of points. And as you can see, it takes a bit of time to actually break it down for you to show you what's real and what is not. It is more nuanced, like most things in life, and it's a little bit more complicated. But I want to thank the team, Sonia, Escobar, Terrell. Thank you guys for helping me with this. And for the rest of you that are watching this, we'll see you next week.
Thank you for having us.
Thank
Pleasure.
you.
Bye-bye.
Bye.